Good morning, everybody. It's Ed Yardeni here. It's April 15th, tax day. I hope you've all paid your taxes or you're waiting for your refunds. I hope that's more the case for most of you. At any rate, lots to talk about. Max is not here, but oh, he did come in. All right, Max is there, and they're having a little love fest there between our new dog Cooper and Max. They're having fun. Anyways, Max had a good call again last week. He said the market will probably go sideways, and it was down 1.5%. It didn't feel like sideways on Friday, but it was a downer. The market's down like a little over 2% through Friday's close based on on Friday's close. I'm having a Biden moment here. So the market has done not too shabbily under the circumstances here. What are the circumstances? Well, we've got the geopolitical situation is pretty ugly. We've got the Middle East boiling over. Everybody's got a different interpretation of what the conclusions are from Iran attacking Israel over the weekend, and the Israelis in combination with American and British forces, and apparently a couple of Arab nations. I think Jordan might have knocked down some of these missiles, but they got a 99% track record of bringing these things down. But that was 300. Presumably, if Iran wanted to, they could swarm thousands of these things towards Israel, and that might overwhelm their defense system. So it was a big success on this first round, but Israel is talking about retaliating in some way, and there must be some discussion going on in Israel about whether this is as good a time as any. There's no good time for something like this to attack the nuclear facilities in Iran. So that's a possibility of some of the discussions that may be going on in Israel. And obviously, if they were to escalate to that level, then we really would be talking about a straight out war between Iran and Israel and all of Iran's proxies, which would certainly bring in the U.S., the U.K., and maybe some other countries into such a conflagration. But the initial reaction of the stock market was, to go to the upside. Things didn't turn out to be as terrible as was feared over the weekend. I mean, imagine if the Israelis didn't have the kind of defense system that has worked so well. The destruction would have been massive. But meanwhile, there's still this war between Hamas and Israel going on, and the whole horrible situation in Rafah. So the Middle East isn't getting any better. Let's put it that way. And yet the price of oil came down somewhat again because there wasn't a direct threat to any of the oil transportation facilities and hubs and paths for over this time period. So I guess I'm getting a little flustered here by having all of my dogs here, not all of them wanting something. But anyways, I'm doing a little dog sitting today, but I think it's the last time I'll do that. It was much better when I just had Max, and Max was sleeping away. Now we've got three of them here. But at any rate, in addition to the Middle East situation, we've got the horrible situation between Ukraine and Russia. And what's going on there is looks as though the Russians have the upper hand. They're pushing against the Ukrainians. Meanwhile, the Ukrainians are scrambling to produce drones, and they've been very successful in having some of their drones take out or at least impair production facilities for oil in Russia. So there's still plenty of risk on the oil side, on the supply side of oil. And we continue to recommend overweighting energy and maybe some precious metals just to have some shock absorbers in portfolios against the shock from these two wars. Meanwhile, where's the stock market in all this? Well, obviously the uncertainty, the fog of war that we're seeing here, both in between Russia and the Ukraine and between Israel and Iran and its proxies. That's clearly a negative for the stock market. What else? We know that inflation's been a little hotter than was expected over the past 3 months. We'll look into the numbers, and I'll conclude that inflation is still moderating. I'm not really troubled by what we've seen over the past 3 months. I still think inflation's moderating, and if that's the case, then that continues to support our optimistic view about the economic outlook and our view that the Fed really shouldn't be lowering interest rates in this kind of environment. I know some people will be talking about at some point that the Fed may actually have to raise interest rates because inflation isn't moderating. Powell's discussed bumps in the roads on the road to lower inflation. But some people could argue that the past 3 months worth of CPI data suggests that inflation is no longer moderating and that it's stuck somewhere between 3% and 4%. And that's unacceptably high relative to the 2% that the Fed has said that they are insistent on achieving. And that being the case, that'll force the Fed to raise rates. That's clearly an outlier scenario right now. Very few people talking about that. But I think more and more people are talking about fewer and fewer rate cuts. I've come to the conclusion there'll probably be no rate cut at all this year. The financial futures and the two-year Treasury seem to be signaling something more along the lines of two cuts in the federal funds rate. And that being the case, that gives you the market some reason to hope that the Fed is certainly done raising rates and still going to lower rates. But I'm of the opinion that we're not going to have a rate cut this year. And we have gone in the markets from thinking 6 to 7 rate cuts now to thinking 2 rate cuts if you look at the futures market and the 2-year. And so there's still room for the market, in my opinion, to conclude that there will be no rate cuts, which could weigh on the market. So the geopolitics, the Fed on hold, and then, of course, we're getting closer to the presidential elections. The domestic politics is a messy situation. I don't think we've ever had. Everybody says the next election is the most important we've ever had. I think it's important to recognize that. I think we all recognize that the candidates right now, assuming Trump is still a candidate after this the latest one of his many trials and tribulations, but if in fact we're talking about Trump versus Biden, then in that scenario, these are the 2 most divisive candidates we've probably ever had. Well, there they go. I may just kick him out of here. That's the best thing to do. Hold on for one second while I do that. Hey. I'm not going to throw them out. I'm just going to herd them, like herding rabbits. Anyways, like I said, I'm doing some dog sitting at the same time that I'm doing this discussion with you folks. I apologize for that sort of interrupting my train of thought along the way here as I see all the activity in the background here. But they're fun, and I hope you don't mind too much. They are kind of on the cute side. You have to admit. So where are we? What's the positive? The positive is the economy is doing pretty well. Retail sales just came out. They were up more than widely expected, 0.7. We were expecting a pretty good number, and that's what we in fact got. And that was based on the strong payroll number and wage numbers that we got at the beginning of the month. So we calculated our earned income proxy, and that was certainly pointing towards strong numbers. So let's go to share some charts here. I went too far back here. Here we go. And this is on the inflation front. So there's a lot of fronts here, clearly. Geopolitical front, Fed front, economic front. Let's focus on the inflation front here. I'd like to just kind of focus on some of the news that's not so bad here on the inflation story, even though the market seems to have concluded that the CPI was a bad number. But let's look first of all at what the markets have been forecasting. We typically look at the 2-year Treasury yield and the federal and the 12-month federal funds rate futures relative to the federal funds target rate. And as you can see, that's come up quite a bit. The spread has narrowed, and as you probably read in the morning briefing that these charts have gone into, our conclusion is the market's still anticipating 2 rate cuts, and in our view, that's still too many. So that could weigh on the market somewhat. Meanwhile, looking at our inflation forecast, this is not the CPI, this is the PCED, but things are still on track in terms of our thinking. As a matter of fact, we're in that 2 to 3% range, and we think that by the end of the year, we'll be closer to 2% for the PCED inflation rate, headline and core. Right now, the headline is still at 2.5%, and the core is 2.8%. So I think this is going well, but this is old data already. This is February, and now we need to turn to March. So let's look at the March situation. This is just GDP. We're still not looking for a hard landing. I will say that it still could be a hard landing if we have a major spike in the price of oil and the Fed is suddenly forced to view this as the 1970s all over again, trying to avert a wage price spiral. So that's conceivable. I think somebody just asked me a question here about the scenarios here and whether it's still 60-20-20. And yeah, 60% is still the roaring 2020s. The economy grows, inflation moderates, the Fed's done raising interest rates, the stock market's close to 5,400 by the end of the year, 6,000 next year, 6,500 after that. So let's give that 60%. And then 20% that it's the great inflation of the 1970s all over again, deja vu all over again. And that would be with the Middle East blowing up, oil prices going much higher, Ukraine attacking Russian oil and so on. So that's 20%. And then 20% to the 1990s, which is the 1990s was in fact sort of like the roaring 1920s, right? I mean, the market certainly had a huge move in the 1990s. There was a lot of excitement about technology and stocks that that provided those technologies. But yeah, it's those 3 scenarios. The 1920s is an analogy, so the roaring 2020s. The 1970s is an analogy, and then the 1990s. Unfortunately, I have to say that I'm starting to think more and more about the 1930s as an analogy, at least on a geopolitical front. It certainly looks as though we've got fascist tyrants on one side. They call themselves the axis of resistance. I think it was Ronald Reagan who called them the axis of evil. So on the democracy side of this great geopolitical battle, we have we're fighting the axis of evil, and from the other side, they are the axis of resistance. Anyways, it's not a pretty picture, and we'll certainly be monitoring it along the way. But the 60% is things work out reasonably well. So let's look at inflation. Inflation clearly is a key variable here. I think you can see this pretty well, but this gets it a little bit bigger. I have it going all the way back to the 1950s. And as you can see here, maybe I'll put on my other glasses because this is kind of tight. Let me see where these the little rascals have left the room. No wonder it's quiet here. So now I just have to worry about what kind of damage the little one's doing, chewing up all the furniture in the house. She's still teething. Anyway, that's my problem, not yours. We should all have such problems, right? If that was our only problem, we'd all be quite happy about that. Anyway, so here's the CPI through March. Look at that CPI less shelter on a year-over-year basis through March. It's 2.3%. That's what it is. I mean, I keep looking at that. Okay, so it's come up a bit. I mean, it's this is the red line, so you can clearly see it's come up like this, but it is volatile. It is bumpy. but it's come down to where it's below 3%. It's closer to 2% than 3%. So I think we've made a lot of progress, and all this talk that inflation is stuck above the Fed's 2%. I just don't see it in the way I'm slicing and dicing the data. I recognize there's other ways to slice and dice it and come up with a pretty pessimistic view. So yeah, I mean the overall CPI is 3.5%, but take out shelter, it's 2.3%. Now, why take out shelter? We all know the story. It's a laggard. It's coming down along with market rents, but it reflects all leases outstanding. But I guess you could tell a story where, well, rents aren't coming down everywhere. There's some indications that in small cities rents are going up, in large cities they're coming down, and that it may take longer to bring rent inflation down. But there's certainly nothing the Fed can do about rent inflation unless it really just hammers the economy, puts us into a recession, and we get a big drop in not just prices, but also wages and rents. But I don't think that's necessary. Here's another slice and dice, the core CPI versus with and without shelter. And you can see that the core is 3.8% with shelter, and again, only 2.4% excluding shelter. And yeah, you could look at this and say, oh my God, it's going up, but let's realize this stuff is volatile. But this is the key here. We've come down dramatically, and shelter should catch up with that. Here's shelter. You can see it's taken its sweet time. There's a chart of shelter going all the way back to 1960. This is the CPI component of shelter, pretty much the same one that you'll see in the PCED. And you can see that owner's equivalent rent and rent of primary residence are both in there, and they've both been coming down, but we have a ways to go, which is a good story, right? I mean, if this thing's going to continue to come down, then this should continue to help to keep inflation on the moderate side. This is consumer price index for goods. I'm seeing deflation in durable goods. That's this little blue line here. The non-durables are commodities. There's energy and food. They tend to be volatile, but look where they were, look where they are now, 1.7%. All right, how about import prices? Well, import prices, again, you can worry that, my gosh, the year-over-year percent change is going up. But let's get real again. It's 0.4 for the import price index for the U.S. and excluding petroleum. It's down 0.2. So I got no problems with that. And then if we drill down a little further and look at import prices from China, which probably matter more than any other import prices other than maybe oil prices, import prices from China are down 2.6%. And you can see that has some relationship clearly with core CPI goods and core PPI goods. We import a lot from China. If they're experiencing deflation and we're importing that stuff, that tends to have a disinflationary, if not a deflationary impact on our statistics. So the core CPI is actually down 0.6% for goods. And so it excludes food and energy, but it's all the other goods, merchandise. And then you've got the PPI final demand goods, and that's up 1.4%. Again, I have really no problems with any of this data. Final demand goods and services, same kind of story. Let's move on to expected inflation. The Fed always wants to conclude that expected inflation is well anchored. And as you can see, it wasn't very well anchored here for the 1 year ahead inflation outlook based on these statistics. The Survey Research Center and the FRB New York has this data, and then we average it together, and you can see it wasn't well anchored. But now we're back down to, what are we down to? FRB, let's say average is down to 3%. Not too bad, not too shabby. We were in this kind of 3 to 2.5% range before the pandemic. So we're getting to where we should be, and kind of pre-pandemic readings. So I think we're getting well anchored there. This is the longer term inflation rate, and maybe there's some issues there, but all in all, I think it's the Fed tends to focus on the 1 year ahead, and as do I. I mean, it's nice to know that the consumers can forecast inflation over the next 5 years. when the rest of us are doing the best we can to get the next 12 months right. Anyways, good news on wage inflation. Didn't make a lot of headlines, but the Atlanta Fed's wage growth tracker is up 4.7%. So it's still coming down, as you can see here in the red line. Average hourly earnings came out a couple of weeks before that, 4.2%. Fed Chair Jerome Powell said that he'd like to see this number down to 3% when he gets inflation down to 2%. So he's basically saying that 3% makes sense if we got basically 1% productivity growth. So he's implicitly assuming that the best we can do is 1% productivity growth. We get inflation down to 2%, then wages should be 3%. Logical, but what if productivity grows faster than that? Let me go to that story. Productivity has been growing faster than that. Last year it was up over 2.5% on a year-over-year basis, so certainly more than 1%. And unit labor costs is hourly compensation divided by productivity. So we had a big increase in unit labor costs. It was about, in hourly compensation up about 5%, but productivity was up more. And so unit labor cost was up only 2.5%. And you can see that's the blue line, and the blue line is highly correlated with the headline CPI inflation rate. Other headline inflation rates, PCED, even the core inflation rates. Unit labor costs is the underlying inflation rate. Most costs are labor costs in our economy, and you can see that they've moderated significantly. And so, again, this looks good to me. Now, where else do we want to go? There is the CPI. I have good news for you. The CPI tends to be biased towards the upside, and the Fed looks at the PCED. So the PCED relative to the CPI tends to be lower. And so if you take the CPI minus the PCED inflation rate on a year-over-year basis, the average difference has been 0.5 percentage point, 0.5%. So that's encouraging. It tells you that whatever we saw on the CPI the first 3 months was probably biased to the upside relative to the more important indicator, which is the PCED. Here's the same kind of analysis for the core inflation rate, and there too you see that the average spread is 0.5%. So the CPI tends to be biased to the upside. Why is that? Few reasons. One is the CPI gives a much higher weight to rent inflation than does the PCED. And rent inflation, as you can see from this chart, this is a tenant rent inflation. This is core CPI, excluding shelter. So you can see rent inflation has a tendency, especially of late, to be running hotter than the CPI excluding shelter. Back here was a different story. But the PCED gives the hotter inflation, the rent numbers, a lower weight. So that's one of the reasons that the CPI overstates inflation relative to the PCED. Here's another one, medical care services. You can see the red line is the CPI medical care services. The blue line is the PCED medical care services. And you can see the CPI again in this category exceeds the inflation rate for the PCED. And I think I did a spread average over time is 0.7. So that's a substantial. Why is that? Well, the CPI is out-of-pocket costs of urban consumers, whereas the PCED includes what the government picks up in healthcare costs, and the government obviously uses its power to pay lower costs than out-of-pocket costs of consumers. Another one, durable goods inflation tends to exceed in the CPI relative to the PCED. And here's a spread, pretty large, 1.1 percentage point. I'm not quite sure why that's the case. It may be that the PCED reflects more hedonic adjustments for the quality of what you're getting. So if you're paying more for something, but it's better from a user standpoint, then maybe that's the difference. But it's clearly an important development. Meanwhile, let's look at rent here. This is the CPI rent inflation rate. And it's, as I said, it's been coming down both for primary residents as well as for owner's equivalent rent. It's been coming down on a year-over-year basis. But what's really encouraging is that on a 3-month annualized basis, it's actually below the year over year. So we're still heading in the right direction from that standpoint. Well, here's the bad news on inflation. And by the way, at first, when I wrote the morning briefing on Saturday morning, I called it inflation, the good, the bad, and the ugly. And then the Middle East thing blew up on Saturday. And so I reversed the order of things and called it the ugly, the good, and the bad. So the ugly is everything that could make inflation go higher, particularly with oil going up and creating a wage price spiral. The good is everything we've discussed up to now. The bad is there's still some annoying, pesky areas of inflation. Home insurance is a real pain for everybody that has a home. And you can see those inflation rates are elevated. And the PCED is actually 7.8%. So it's actually higher than the CPI. These tend to be tiny components of inflation, but if they have big moves, they can add a point, 0.1 to the numbers. And suddenly, if instead of 0.3, it's 0.4, oh my God, inflation is out of control. Here's motor vehicle insurance. And there too, you see that the CPI is up 22.2%. On the other hand, the PCD is up only 7.8%. So that's the problem. Well, what's going on here? Well, we know that car prices have been going up. This is the level of various auto-related indicators. So this is new and used car prices. They've gone up. We know that auto maintenance and repairs have gone up, and so auto insurance has gone up a lot in the CPI. And then finally, another kind of weird number is the health insurance component, and you can see that it's all over the place on a CPI basis. It's calculated in a very crazy way. Makes more sense on a PCED basis. It's still down on a year-over-year basis, but it was a big increase on a month-to-month basis. And so the bottom line is the PCED inflation rate is going to be lower than the CPI inflation rate, and that number will be out later this month. Let me open it up. I don't think I've got any. Yeah, they've all escaped. I have a feeling my wife showed up and opened the door and gave me a break from having too many dogs. Like I said, I can handle. Max is easy to handle because he's always sleeping. But when I got the 3 of them here and the new one is jumping all over the other ones, it's a little bit of a rattle. So, anyways, I'm not rattled anymore. Cagdis, okay, Cagdis, you asked your question about 60-20-20, and I think I answered that. Steve, as you've mentioned before in your book and on these broadcasts, the 2% inflation target is not based on science. Is it possible that they could at some point adjust the target going forward to 3%? And what are the chances of that happening, in your opinion, either by Powell or a new Fed chair should Trump be elected? The chances of Powell doing it are slim to zero. I think he's really cornered himself with this 2%. I think he wanted to show his reestablish his credibility as an inflation fighter. So he came out real tough, gunslinging, saying that, we're going to get inflation down to 2% no matter what it takes. But along the way, he said hopefully it won't take a recession. And it looks as though we may actually be getting that kind of scenario. But I seriously doubt that Powell is going to reverse himself and say that 3% is good enough. On the other hand, as you said, if Trump's elected and somehow or other manages to get Powell out of there early, maybe Powell just will kind of resign and say, I just can't be bothered with this anymore. It's conceivable that there'll be a new Fed chair, but there's other people on that committee. The Fed chair is not the only one. And over the years, we've had a lot of accord on these committees with occasional dissenters, very few and far between, and usually one or two at most, sometimes 3. But we haven't seen any discord in this Fed for a while. So it's conceivable, but I think it's more wishful thinking for somebody who would like, as I would, for the economy to grow without getting all hung up on 2 versus 3%. But at this point, I think psychologically 2%, the Feds just kind of almost locked themselves into getting it down to 2%. Joe, Ed, which one of your economic indicators would give you pause regarding your inflation outlook downtrend? Good question. Let me think about that a little bit. Knee jerk, price of oil, obviously. I've been talking about that. I wouldn't I wouldn't be surprised if the Middle East situation continues to blow up, if oil prices go up, if that triggers another wage price spiral. So I would say that would be the probably the number one indicator. Everything else is going swimmingly well, as they say over in the UK. I think that we're seeing inflation moderating, as I said, kind of as we thought back in summer of 2003. I'll say we started to say that that was the peak and it would continue to moderate. Okay, Gary, what is the reality of inflation at the grocery store that everybody still complains about prices going up? Well, we just looked at that chart of price levels, and everybody's right. Price levels are substantially higher than they were before the pandemic, for food, for insurance of all kinds, for clothing and things like that. We've had a real spurt of inflation here, and we're not getting deflation right now, and so prices haven't come down. So if you actually look at the level of prices, they are elevated and higher than people, much higher than what people recall early on in the pandemic and before the pandemic, and that apparently is creating a lot of explanation for why consumer confidence has been rather low. On the other hand, as I also just showed, the surveys of inflationary expectations on a one-year basis are extremely realistic. They're showing 2.5% to 3%, which is what inflation is actually doing. So it's not as though all these, TV reporting on how, interviewing consumers and how they're complaining about how much higher prices are. They're absolutely right. But they obviously can also discriminate. They understand the difference between price levels and inflation. And I think it's price levels. And look, for a lot of people, wages have gone up, but for some of the essentials in life, including, especially, I kind of dismissed these insurance policies, but insurance hits everybody hard. Auto insurance, home insurance, all these things matter. I'll take one last one here. And that is, let's see if I got it here. Yeah. Do you think the Fed will cut rates anyway, despite strong growth and inflation as election put? I don't think so. I think we'll hear more Fed officials saying that inflation is still an issue for them, and they don't feel that the Fed is ready to lower rates anytime soon. And of course, quite the opposite. The more time that passes, we're going to have the summer conventions, political conventions in, I think, July and August. So it's kind of hard to imagine that the Fed's going to want to make the headlines at that point. And then certainly not right before the elections. They say they're not political, but they're realistic. And I think they will, if they cut, they'll cut in their meeting right after the presidential election. It's in early May, right after the election. And so it's still conceivable from that scenario that there would be 2 rate cuts at the very end of the year, but I'm not convinced even that's going to be the case. Well, thanks everybody for joining me. I hope you enjoyed the circus that I had here earlier with all the dogs. It was more of a circus than I want to handle in the future. So from now on, it'll just be Max. And Max, by the way, is still cautious on the market. So that's where we are. Thanks. See you next week.